So today's topics, we're going to talk about the current state of the union. We're going to talk about market and financial insights and also changes we're making in the portfolio or making recommendations with interest rates now starting to recede and become reduced. And we saw a 50 basis point interest rate reduction by the Fed. And we're going to talk about that today. We're expecting to see at least another 50, possibly 75 basis points, depending on who gets elected or anointed, depending on how you feel about those things. We're going to talk about the two different tax policies of both candidates. I think all of you know me well enough to know I don't really go with the party. I was a Democrat for 25 years. I was a Republican for 25 years. Fact of the matter is, right now, I'm a constitutional tax-paying conservative, and that's the way I look at myself. I've watched these politicians, and it seems as though since they're not held accountable for their lies because of, I guess, something that was a bill that was passed in Congress many decades ago, it seems like many of them just continue to lie, deny. I can remember my very first law class. Professor, what the heck was his name? Cotterall said, in order to be a great attorney or a great politician, you need to learn one thing. And the class said, what is that? He turned around on the blackboard. This is when we had chalk and blackboards. And he wrote in big print, lie, L-I-E, 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 lie. And then underneath, D-E-N-Y, deny. So I guess that's what we're seeing. Maybe many of the politicians today were taught by the same people who taught Professor Cotterall. But in any event, we're going to talk about the actual tax policies for each one of the candidates and how it will affect your portfolio and how it will also affect our Roth conversions, okay? So the current state of the union, let's talk about inflation. We have short little memories, and unfortunately, I think if many of these politicians just stuck to the facts, it would be a lot easier for folks to understand. So let's talk about, forget Barack Hussein Obama. We'll forget those 8 years. Let's start with Trump and the Trump administration, not Donald Trump, his administration, and the Biden-Harris administration, not them, their administration. So I strictly want to talk about policies, through their administrations. The annual inflation rate in the United States from January 2017 through January 2020 was very simply stated. In the year 2017, when President Trump had his first year in office, despite much of the debris that we had to listen to, inflation was simply at 2.1%. In 2018, inflation went skyrocketing all the way up to 2.4%. In 2019, we were at 1.8%, and in 2020, the year of COVID, we still did not see runaway inflation. We saw inflation at a rate of 1.2%. Why? Why did we see inflation so low? It was strictly the policies. They believed in lowering taxes. With that Trump Cuts and Jobs Act, it significantly reduced taxes for all of us. And with that being said, we had security in the country. We had a closed border. They were building the wall. We saw a lot of jobs in the private sector. When I say private sector, we're talking about tax-paying jobs, not as opposed to government jobs. Now, let's take another look at the Biden-Harris administration, and we're looking at the same thing, year-over-year inflation. Now, of course, this was Trump's fault, right? It really makes me laugh, and this is why it amazes me that much of the media does not fact check. These numbers we pull right off of the government's website, okay? It's very easy to find. In 2021, this was the year after they were handed a 2020 inflation rate of 1.2, and because of runaway, reckless government spending on the new green steel or whatever you want to call it, inflation first year went up to 7%. In 2022, this is year over year now, it went up an additional 6.5%. Now we're looking at 13 because you have to accumulate these things. 13.5%. In 2023, again, the Inflation Non-Reduction Act. This was what it was. It was really wrapped up. They gave it a name. It had nothing to do with reducing inflation. What it did do is exacerbate inflation. Went to 9.1% in June. And with that being said, this year so far, it's down to 2.5. Well, here's how you add it up. If you take a look at the average inflation, when Trump was in office, averaged 2.1, 2.4, 1.8, and 1.2, you're going to get an annual inflation rate of close to 1.85%, an average through the 4 years of per year inflation. When you take a look at the Biden-Harris inflation rate over the last 4 years, yes, it dropped down to 2.5, but not 2.5 over the last 4 years. When we take a look at the last 4 years, this son of a gun has skyrocketed. It was 22.6%. In 3 years. That would be 21, 22, 23. If you take a look at it, each year, inflation has averaged over 7.5%. So when they talk about inflation coming down, not so much. I don't know if any of you folks have looked at your auto insurance bill. Well, our auto insurance bills have gone up over 35% just in the last year. That doesn't tell me that we're reducing inflation. Take a look at your homeowner's insurance bill. That's also going up between 20, 30, 40%. So when we take a look at what caused this inflation, it broke down to one specific policy. There were many, but the one biggest policy, the war on domestic energy. It was okay for us to shut down oil producing on government lands. They shut it down. Again, not getting into policy, not getting into politics, just looking at policy. This was the difference, the primary difference. Next, let's talk about interest rates. You know, for the last couple of years, we've been moving our clients into safety. And in part of using that safety, we've been using both Fidelity and Charles Schwab's, their Schwivix, their money market account. Well, that money market account has been yielding 5.1, give or take. They change the yield every 7 days. But the fact of the matter is, it's been a pretty safe place to park our money for clients who wanted to reduce risk and while still keeping their funds liquid and not tying them up in CDs or any type of long-term investments. So now the Fed has, and also through 2022, we saw interest rates go up over 4.5% within a 15-month period. Well, many of you folks who had other advisors back then, especially if you were in a 60-40 portfolio, 60 stock, 40% bonds, or even a 40-60, as interest rates went up in 2020, your portfolios, your bond portfolios lost value. On average, 5.5% a loss in your bond values for every 1% that interest rates were increased by the Fed. So for many of you, and we've run Morningstar reports literally on hundreds of clients, and we look at their returns in 2022, and they were devastating. From 2022, they've really only averaged about 3%. In many cases, if it was a well-managed portfolio, 7% per year. Even with the explosion that we've seen in AI in 2023 and 2024. Well, now what's happening is interest rates, what we're looking at is we're looking at the federal fund rate about ready to switch gears. Now, the way bond interest rates work and affect the value of a bond portfolio as it's like a seesaw. As interest rates go up, okay, your bond value drops. As interest rates go down, your bond value increases. So with this, what we're going to see, and you've already probably started seeing us add Double Line, which is a bond portfolio. We're also about ready to unleash our new ETF. It's going to be a 7 to 12-year treasury. The idea is to keep the money liquid. We want to keep it in ETF so we can liquidate it without actually buying the bonds. But we want to take advantage of the increase and the safety of increasing bond values as interest rates now decrease. We're expecting to see interest rate decreases. And again, this is a little bit of hyperbole. We'll see who gets elected. But fact of the matter is, we expect another 0.5% between now and the end of the year. And next year, they're talking about 1.75 up to 2.5%. So we're going to be switching out of the SWIFTs and into more of a treasury. Why? I want to take advantage of that increase in interest, increase in value of your bonds with the decrease in interest rates. Let's talk a little bit about our national debt. Why don't we just call it the national disgrace, okay? The fact that we're getting ready to finish our fiscal year, I believe it's the 14th of October, so we have about 2 weeks to go. We've taken in over $5 trillion in taxes this year, just this fiscal year. We've borrowed $2.1 trillion, just simply amazing. And when we take a look at it, the interest on the debt alone is expected to reach $1.2 trillion. Right now, we're just about $1 trillion in interest. Now, let's wrap our heads around this. $1 trillion in interest for 1 year? How good is that for the economy? This is another reason that we are seeing runaway inflation. Now, it is starting to subside a bit because they're loosening up the oil, but at any rate, we are starting to see imports from crude, from other countries like Venezuela. But the fact of the matter is we're putting more supply. And again, when you put more supply on the market, you're going to see a reduction in the cost. I want to talk about this debt because at $40 trillion, the Comptroller General is telling us that what we're going to see once we hit $40 trillion is if the current policies stay intact like they are now, and possibly, as we're going to get into the next slide, even increase in taxes, we're going to see tax rates go up somewhere between 20 and 30%. So we don't default on the debt, and we also continue our Medicare, Medicaid, Social Security, and the like. So with that being said, really when it comes down to it, what we're looking at is we really want full employment. So let's talk about some of these full employment numbers. Jobless claims did fall by about 3,000 to about 28K. The claims are continuing to climb, though. Total claims are jobless claims. That is jobless claims, 1.834 million jobs. Employment growth in government, though, is accelerating. In 2023, we saw all of these new jobs that they're talking about. Well, it's great, wonderful. What sectors are they? Well, 709,000 new government jobs just in 2023. You realize the government has to take taxes from us in order to pay a government job or a government employee. So government doesn't produce, it basically extracts. So when you take a look at some of these numbers, to me, it's a pure economic shell game. Also, the growth in 2022 was another 299,000 government jobs. We had another plus 392,000 government jobs in 2021. Sweet Lord have mercy is all I can say with respect to that. So let's go ahead and get into the markets financial update. The S&P's gained 0.6% last week, also hitting another 42 or its 42nd all-time high just this year. So again, we're seesawing. It's going up, it's going down, up and down. But the fact of the matter is, when we take a look at the sector, semiconductor sector, it's really, and the AI boom that we've seen, this has really contributed. Just like during COVID, we had like the fantastic 6 or 7. Well, we got locked down in our homes. So if you had Amazon, if you had Costco, a lot of these companies that were allowed to stay open basically drove the economy with this V-shaped recovery. We're seeing a similar thing here. So equity markets through 2023 and 2024, I know many of the current administration, they'd love to take credit for it, and maybe there's some credit due, but the fact of the matter is, I have to look at technology taking full credit for the increase, not only in the stock market, but also in our overall, not only in the stock market, but all overall growth. There's a little bit of move. I just wanted to let you all know there's some news out of the Department of Justice. They're investigating super microcomputer for accounting irregularities. You know, I don't even know what to say about that. It just seems like government goes in an election year. If you're doing well in business, they seem to come after you. Let's get into U.S. Treasury markets. The 2-year fell it fell 1 basis point to 3.56. And again, the 10-year yield increased a couple basis points, but overall, we're seeing a decrease in interest rates, which will increase our bond values. I want to talk a little bit about this presidential election. It's really the most important election of our lifetime. I just want to look at it as an auditor. I used to love auditing because you could give a person all the lip service you wanted, but the numbers never lied. People did, but the numbers never did. Okay, so let's go ahead and take a look at this. Business taxes. So we're going to talk about, this is the Trump administration proposed tax plan. Let's go ahead and dig in. So the first thing is they want to lower corporate income taxes. The current corporate income tax, which was part of the Trump Tax Cuts and Jobs Act, is a rate of 21%. He wants to lower it another percent to 20%. He also wants to lower income tax rates to 15% for companies that come back to the U.S. and produce here. And he wants to give them this rate for an extended period of time, between 5 to 10 years. Now, this is designed to not only bring jobs back home, but reach full employment. And we're talking about the common people like me and you and our kids and our grandchildren, not necessarily just growing government jobs. So we want to talk about, in addition to that, they want to take capital gains and a dividend tax, and they're not proposing any changes in either one of them, making it the same. Anyway, ranging from 0% if you're below $91,000 in income to as high as 15 or 20% if you sold a large property or something of that nature. But Vance is discussing increasing the child tax credit to $5,000 per child. I think it's a good idea. I think people raising children, especially with the cost of everything, diapers, milk, formula, if you can even get it, I think it should help. Reinstating an unlimited itemized deduction for state and local, or what they call a SALT tax. I'm all for this. I really am. For those of you who live on either the East or West Coast, they reduced your property tax deduction to $10,000. So if you were paying $14,000 a year or $20,000 or whatever it happened to be, you only got a deduction of $10,000. They want to bring it back, and they want an unlimited itemized deductions. Even if you own multiple properties and pay multiple real estate taxes, they want to bring this back. So I see this as a positive. Also, the estate and wealth tax. This is a very big cliff we're heading to, folks. And again, the positions can't be more stark or different between both of the candidates that are running. The Trump administration wants to make the expiring estate tax cuts from 2017, by the way, which ends January 1st, 2026. They want to make that permanent. And I think that's a great idea. I think the less you tax, the more you give to people to spend, they can spend it much better than government can spend it. And this has been proven time and time again. One of the other things I want to look at is the individual income tax, okay? Look, many of you folks who are going to be partying with us in Horseshoe Bay, you all know how I feel. I've said it over and over again, almost ad nauseum. I believe that anyone that has paid taxes for the last 50 years, like we have, once we reach the age of 75, should retire totally tax-free. Now, fortunately, this government, both sides, have given us the option to do that. And this is how we execute these Roth conversions. You're going to meet over 200 people who we have worked with, clients we've worked with that are retiring tax-free. And for some of them, it took 2 years, 3 years to do their conversion. For some of them, it took up to 10 years. Everyone's plan was individualized and different. But the fact of the matter is, they're keeping more of their money in retirement. So this is what I like to see: increases or decreases in individual income taxes. They want to replace the personal income tax with increased tariffs. In other words, if China moves to Mexico to take advantage of the North American Free Trade Agreement, which was signed back in the Clinton days, they want to slap a tax on any goods that come in that are competing or manipulating their currency. And I like that. We have to become more competitive on the world stage. So by replacing the personal income taxes with increased tariffs, I see the positive and negative in it. I see primarily positive if it's done properly and if it's done to motivate free trade and bringing jobs back to America for our children and grandchildren. They want to reinstate an unlimited itemized tax deduction and also bring back deductions for our local and state taxes, getting a deduction for that. I really kind of like that. They also want to exempt all taxes on tips. I think it's a fantastic move. I think for most of these folks, you look at some of these IRS audits, and believe it or not, many of these audits, from what I understand, are folks making $100,000 to $125,000, $30,000 a year, many of them in services industry, auditing their tips. I think it's ridiculous. And he also this administration wants to eliminate taxes on overtime pay. Imagine that. If you eliminate taxes on tips, you're going to want more people are going to want to get out and actually work and serve people, work in the service industries. If you eliminate taxes on overtime, this increases productivity because people are going to want to work more because they get to spend more of their money. So I look at this overall proposed tax plan from the Trump administration, and I have to say, all in all, I like it. I think it will stimulate, and it will not only stimulate productivity, but it'll reduce inflation as well. Now, let's take a look at the other side of the coin. We're going to call it the Biden-Harris administration. We just reviewed the inflation numbers from 2017 through 20 for the Trump administration and the inflation numbers from 2021 through 2024. Stark contrasts. So let's take a look at what these folks want to do. Well, again, that's give me more of your money. Like my dad used to say, son, there are only 10 dimes in a dollar. If you have to give the government 4 of those dimes, you only get 6 to spend. If you have 10 dimes in a dollar and you get to keep all 10 dimes, well, then you have more of your dimes to spend. Fact of the matter is, the less you give government, the more you get to keep yourself, the better off your family in the end is. So let's talk about it. They want to increase the corporate tax rate to 28%. Sure, great. So they want to increase the top tax rates for long-term capital gains to 28% for all income above or up to 1 million. If you have income over $1 million, they want to raise that capital gains. They want to make it ordinary income tax as high as 44%. They also want to increase net investment income tax. That's called the NIIT tax, to reach 5% on incomes above $400,000. I hate to break it to you, folks, making $400,000 a year today on a regular family, it's not enough. It's simply not enough. After you get finished with the taxes, when you take a look at the inflation that we've been saddled with, it's not a millionaire and billionaire. $400,000 are folks that I believe both parents in many cases are working and they're trying to just educate and feed and clothe their children. They want to expand the earned income tax for filers who do not claim children. So imagine that. Let's say you don't have kids as a deduction, but you just got done raising your 5 children and maybe you're helping your kids with the grandchildren. They want to expand the earned income tax credit for these filers. They also want to expand premium tax credits. They want to expand housing tax credits, including low-income housing credits. When did we see this before? Back in the Clintons, you remember everybody deserves to own a home, no money down, prices for homes skyrocketed, and what had happened? The federal, administration told the banks, if you don't issue these loans, we're going to revoke your FDIC charter. Again, government getting in the way of doing business. And what happened? We saw the crash of 2008, where over a 15-month period, the S&P 500 dropped 52%. We never saw it in history. So do we learn the lessons of the past? I guess some administrations don't. They also want to institute a clawback deduction for depreciation and interest for certain rental construction investments. That'll increase construction. I know I'm being a little sarcastic, but these folks obviously know very little about economics, or they're doing it on purpose. One or the other, okay? They also want to increase the $5,000 deduction for startup companies for up to $50,000. So one of the things, one of our clients had said, yeah, it's a CPA, he said to me, Phil, of course they're going to give you $50,000 to start up a business. I said, well, they're not giving me anything. They're taking money from us to give to someone to start a business. The estate and wealth taxes expire January in 2026. Right now, if you have an estate of over $13.8 million, now they backed away from it, this Harris administration, but what they want to do is revert it back to $5 million. Any estates over $5 million will be taxed, and again, we'll take a look at it, but they want to tax it between 45% in anything in excess of $5 million. In other words, if you have an estate, and this includes your property, it includes your jewelry, it includes your IRA, your Roth IRA, all of your assets. What they want to do is anything over $5 million would be taxed at a range of 45 to 55%. Let's say you have an estate of $10 million. Great. The first $5 million, you don't pay a tax on it. Okay, great. Well, now it's $13.8 million, but we'll take that. What about the other $5 million? Well, that tax is going to average a progressive tax between 45 and 50%. So in other words, your federal estate tax bill, after you got finished paying taxes your entire life, another potential $2.5 million. Again, it's the government reaching in and grabbing your assets. This does not enhance productivity, but that's another story. Also, they want to they want to take the individual income tax. Now, it's funny, Trump comes up with this no tax on tips, so does Harris. If you look at it, I guess where all of these housing credits, Medicare tax, they wanted to increase our Medicare tax up to 5%. Right now we pay 1.9% or 1.8%. It's 0.9% per person. They don't want to increase our Medicare tax for folks making $400,000 a year up to 5%. In addition to eliminating the Tax Cuts and Jobs Act, which is going to sunset in 2025. So when I look at Plan A, Trump plan, and the inflation during that period, it was very conducive towards growth in our country. All of you out there, okay, I know we have several hundred people watching. My recommendation, this is the most important election in our lifetimes. It's extremely important that you tell your children, if they're not registered, get registered, and your grandchildren, go out and vote. Don't need to tell them who to vote for. If you arm them with a couple of facts, this is their country too. They're going to inherit this debt as well. So when we take a look at it, I think the choice is easy to make. So let's talk about our current portfolio recommendations, and then we'll wrap it up. Basically, right now, many of you, as we've seen, we feel very comfortable in the market overall, especially up into the election. For many of our clients, we've been recommending our large cap growth stock portfolio, has no internal fees. Our large cap dividend portfolio, we really like this. Our core series is also extremely important and very well managed. It's been managed by BlackRock using our own group of proprietary funds, but they've done a great job. BlackRock took on Foundations, our parent company, back in March of 2020. So I'm very impressed with the active trading. I'm also very impressed with how it's been managed. For many of us, combination and percentages in these portfolios are totally different based on each client's individual suitability and risk tolerance. We do not have an all of the above mentality. Many folks may have more or less of our large cap growth dividend. Many of our clients will have more or less of our cash or our double line intermediate or any type of growth and income annuity. Everyone's different. We coordinate it based on your risk score and your risk tolerance. One of the things I'd like to discuss for those of you who are concerned about financial Armageddon coming up on us, we now have a situation. For most of you, you know that my youngest son, our youngest son, my beautiful wife and I's youngest son, Parker, works with our parent company in Phoenix with Foundations. He's going to be graduating in July. He spent 3 years up there, and he's simply amazed. I'm simply amazed at the amount that he's learned from as a junior trader and an analyst, working with these PhDs and these marvelous people up in Foundations. But we have now been allowed to institute bulk trade allocations. And what this means, and this is not for every advisor, but this is for our specific group, we will be able to, if we were to see, God forbid, some sort of a major catastrophic event, God forbid a terrorist attack, you name the drama, okay? We have the ability to move our clients into cash and cash alternatives within a relatively short period of time, and we can do it almost instantaneously. And this comes under our bulk trade allocation. For many of you, we have put a limit on your market volatility. Not all of you, but for most of you. You know how I feel about that. If the market's dropping 20, 30, 40%, we want to be on the sidelines somewhere around a 10% drawdown, no more than that. Maybe it ranges to 12 or 8, but we need to be able to act actively and act quickly. I'd rather rebuy again once we reach a trough. This worked quite well in 2008. So we now have the ability and have the technology to do these bulk trade allocations. Why? I want to keep your portfolio safe. My number one job is to reduce your taxes and keep your portfolio safe while we receive a fair return. We want to make sure that you're safe. We want to make sure that you're happy. I want to make sure that you're tax-free. So, a couple different general administration reminders. RMDs, we're coming into RMD land. If you are charitably inclined, folks, we want to be able to do these 501c3 RMD pass-throughs. All RMDs must be processed no later than December 31st. We don't like to wait until the end, except if this is your first year. If this is your first year for collecting an RMD, it may be more tax efficient to take 2 RMDs next year as opposed to this year. Give us a call because you're allowed to take 2 in 1 year if it's your first year. Give us a call if you're not already scheduled your RMDs for 2024. We don't want to rush at the end of the year. Roth conversions. I love doing these mock tax returns. For many of you folks, it's amazing. Some of our clients I've been working with for 10 years, they're like, we're tax-free. All of our money is now on a Roth. We're getting about $65,000, $70,000 from Social Security. And because we're taking distributions from Roth, none of our Social Security is taxable. What you said, Philip, actually is coming to fruition. Again, remember the 10 dimes and the dollar. We want to keep all 10 dimes. I believe we paid our fair share once we paid taxes for 50 plus years and reach the age of 75, 80. So if you haven't done your Roth conversion, if you have an Allianz annuity that we're doing internal Roth conversions for, it has to be done by December 4th. Your Schwab and Fidelity, we're custodians. They're our custodians. We manage these portfolios. Whether it's in a 401k, 403b IRA, or Roth IRA, if it's Schwab or Fidelity, all Roth conversions must be completed by December 10th. We can do Roth conversions. You don't have to come into the office. We can do a teleconference. In fact, I'd urge a lot of folks to use the teleconference option because we're literally going to be inundated with hundreds of Roth conversions, especially depending on who gets elected. Sorry about that. If we see the Biden-Harris administration, they're going to let the Trump tax cuts expire. They want to raise the corporate income tax up over 28%, which will make us the least competitive business to do business in the world. We see a major downturn. And by the way, we have a portfolio to fit any administration. This is the benefit of active and tactical asset management. I want to thank you for attending our webinar. Our next one will be shortly after the election, on Monday, November 18th at 11 a.m. God bless you all. Be safe and be well. And I look forward to seeing each and every one of you. Okay? Thanks for attending and have a wonderful, wonderful day.